Good day, doctor. My name is Lee Pei-ying, matrix number 2777184. To find out the effectiveness of management in generating sales from operating assets of those companies, we use the disaggregated measures of asset turnover. To make us easier to do the comparative, we calculated the average ratio of those companies based on the years. From 8 ratios, we only take 3 for here to presentation. The first ratio is inventory turnover. It can show the times a company sold and replaced the inventory, and this can predict the competitiveness of the inventory also. And the next is long-term operating asset turnover. This ratio can show the productivity of long-term operating assets on how much sales can be generated by the long-term operating assets. And the last ratio is net operating working capital turnover. This ratio measures the effectiveness of a company in utilizing its working capital to generate sales. These three ratios have the positive relationship with the effectiveness on generating sales, and this means that the higher the ratio, the higher the effectiveness. From the 8 asset turnover, we found that Connect County and the GES Group Berhad have the most effectiveness in generating company sales by operating assets.
A very good day everyone. I'm Jutika Kaleselvan, metric number 279996. Today I'm going to explain how this aggregate measurement of asset turnover will affect companies' return on net operating asset, which is long-term operating asset turnover and net working capital turnover. First of all, long-term operating asset turnover have an indirect impact on return on net operating asset. If long-term operating assets are well maintained, there will be more productive and improved sales. As a result, the greater the operating income, the greater is return on net operating assets. Next, sales will arise if the firm uses its working capital fully. You may be aware, a rise in sales or operating income will result in increase in return on net operating assets. In summary, this aggregate measurement of asset turnover will have a direct influence on operating income, will have an indirect impact on return on net operating assets. Thank you.
Zero is about evaluate the credit analysis of the selected company and discuss the advantage of each ratio related to the credit analysis. Trade credit receivable are the sum that customer owe a company after they have purchased the product or service on the credit, and trade receivable is the current asset of the firm. And this ratio will help the firm to assess how well a business generates the money and how efficiently it utilizes its resource. And the average ratio that are measured in 100 or 360 days will measure the average day of the firm to collect the account receivable in this period. In general, a higher ratio is much better because it means that the client pay the credit on time. The ability of the firm to collect the account receivable is better, but if the ratio is measured in days, a lower average period will be much better. Trade payable is a sum that a company supplier bill the firm for the items supplied to the product or service used by the company routinely, and the average ratio that are measured in 100 or 360 days will measure the average day of the firm to pay the debt in this period. And usually a high average day payable is generally a good thing since it indicates that the firm has additional cash on the hand that might use for the short-term investment, but if the company pay the creditor too slowly, they can just decline to provide them further credit. And if the average day payable is low, it means that the company able to pay the debt in a quick way, and it also indicates that the credit condition of the company is not favorable like their rival, potentially because of the poor credit history or the failure to take advantage of a negotiation possibility.
Through a business-to-business trade credit arrangement, a client can buy items without paying cash up front and repay the supplier at a later agreed-upon times. The difference between trade credit receivables and trade credit due divided by sales is known as net trade credit. Actually, the advantage of net trade credit ratio to credit analysis able to divide into two distinct groups, which is buyers and sellers. Buyers benefit from net trade credit ratio since it is straightforward and convenient to use for financing. It is also cheaper for everyone because it has no additional cost compared to other forms of funding. On the other hand, sellers have a high net trade credit ratio are better able to build trusting relationships with their customers and win their loyalty. Additionally, since there are no fees for financing, consumers are more likely to make larger purchases. Additionally, the current ratio is a liquidity ratio that assesses a company's capacity to settle short-term debts or those due within a year. Its ratio between current assets and liability is what is known as this term. The current ratio is useful in determining a company's liquidity. It aids in our assessment of a company's near-term financial stability. The current ratios provides insight into the business cycle, understanding how effectively a company sells its goods, specifically how quickly it can turn its inventories or current assets into cash. An organization can maximize its productivity by knowing this. In addition, the cash to current assets ratio, a liquidity ratio, gauges the proportion of a company's current assets that are made up of cash and cash equivalents. Calculate the cash to current asset ratio by dividing the cash amount by the current assets. Investor can determine the company's ability to settle its account payable by looking at the cash to current assets ratio, which tell analysts and investors what proportion of cash is contained in current assets.
4.0 is about the factor affecting earnings per share, EPS, and price to earning, PE ratios. The factors are number 1, profitability, which is net income over total asset ratio. And number 2 is leverage, which is long-term debt to total asset ratio and total debt to total asset ratios. Number 3 is liquidity, which is using current ratio. Number 4, firm size, which is total asset of the company. Number 5 is productivity, which is inventory turnover. And number 6 is board size, which is number of directors. Under the factors, the SPSS result shows the factor affecting earnings per share, EPS, is capital structures and board size. Under the capital structures, when the debt increases, the company will increase the equity of their financings. And the increase in the equity will lead to an increase in the number of shareholders, and this will decrease the EPS. On the other hand, when the bond size increases, the number of the shareholders will also decrease, and the EPS will decrease because of the return is divided into more shares. However, the factor affecting the price to earning PE ratio is firm size and productivity. Firm size, as the company assets, is designed to generate the maximum return, and the higher of the earning, the lower of the PE ratio. Next is the productivity measured by the inventory turnover. Higher inventory turnover represent the higher sales and replacement inventory for a company. The higher return affect the EPS of a company and indirectly affect the PE ratios.